Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to our latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management and is a consultant to the U.S. intelligence community and the Department of Defense. He's also an advisory board member of the Physical Gold Fund. Hello, Jim, and welcome.
Hi, John.
And we also have with us Alex Stanzik of the Physical Gold Fund. Hello, Alex.
Hi, John. Great to be here.
Alex will be looking out for questions that come from you, our listeners, so let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question, and as time allows, we'll do our best to respond to you. So, Jim, let's return to Europe, where we spent quite a bit of time in our last webinar. So the Greek drama continues to unfold, but just as you predicted, there's no sign of a so-called Grexit, meaning a breakaway of Greece from the European Union. What we do see are some awkward compromises by Greece's radical new government, such as raiding the country's pension funds to pay back the IMF. How do you read this story?
Well, I think the question itself, John, and the introduction is a pretty good sort of capsule summary. The story is not over by any means. In 2,400 years ago, if we went to the Acropolis, a real Greek drama, it would be over in a couple hours, but this drama is going to continue for a few more years. My expectation is that there will be no Grexit, that Greece will not leave the euro. They will not be forced out of the euro. They will continue to use the euro as their currency. So that's the big picture. I think the big thing that investors need to stay focused on. And it's a very big deal because if Greece did on its own exit the euro, or if they were forced out by German or other participants in the EU or IMF, etc., that would not be a small event. That would be, in my view, catastrophic. Now, a lot of people have tried to write it as a small event, and their analysis sort of goes as follows. Greece is a very small economy, which it is. It's not only small relative to the world when you've got giants like China, US, and Japan, but it's small relative to Europe. The Greek debt is significant relative to Greek GDP, but it's not that big a deal relative to European GDP, et cetera. So you get down a bunch of metrics, whether it's population, GDP, debts, GDP, et cetera. The Greek economy is not that big a deal. But that's not where it would end. In other words, if Greece were kicked out, markets always discount the future. They look 2, 3, 4 moves ahead. Policymakers may not. A lot of analysts may not, but markets do. And I think that the best analysts are always trying to do the same thing. The market would immediately begin to discount the possibility of Spain leaving, discount the possibility of Portugal leaving, and then ultimately Italy, and then France, and then all the dominoes falling. See, that's the problem with dominoes. It's not the first one. It's all the ones that are lined up after it. The idea that you could sort of clinically, surgically remove Greece, but nothing else bad would happen is not true. Certainly history, a lot of history, but just go back to the two most recent episodes of Contagion. Let's just do the European debt crisis. That actually didn't start in Europe. It started in Dubai the day after Christmas, 2009. Dubai World kind of unceremoniously announced that they were not going to pay their debts, well over $100 billion. And that caused everyone to say, well, wait a second, if Dubai can't pay, are there any other weak links in the chain? Of course, people immediately took a look at Ireland, Greece, and Portugal, and that was the beginning of the European sovereign debt crisis. Same thing in 2007, 2008. You saw those Bear Stearns-sponsored hedge funds collapse in July 2007. Spreads started to blow out. There was a lot of panic, but by December, the view was, well, it looks like it's all under control. The sovereign wealth funds are coming to the rescue. They're recapitalizing the U.S. banks. It's all good. But then, boom, March 2008, Bear Stearns. Boom, June 2008, Fannie and Freddie. And then the biggest explosion of all, September 2008, Lehman, AIG. And then we all know what happened from there. So you can't knock over one domino, or as I like to say, you can't disturb one snowflake the wrong way without risking an avalanche. So that's why Europe wants to keep Greece on board. Now, Greece, for their part, want to stay in the euro. Poll after poll shows the Greek citizens want the euro. That surprises a lot of Western analysts, but they do. They know what happens when you go to the drachma. What happens? Well, they inflate the value of the drachma and steal your savings, steal your pension, retirement, your insurance. Any fixed income obligations go up in smoke. And so they've seen that movie over and over again over the last 30 or 40 years, so they like the euro. Basically, what would happen if Greece left the euro? Well, you would hyperinflate the currency. That would cause more social unrest than they already have. It would dry up direct foreign investment. No more Chinese investment coming into Greece. No more ability to borrow money. No more ability to roll over debts. Greece would be kind of reduced to, maybe less than a third world economy. Something more like not even the Balkans might even be an insult to the Balkans. So the dynamic is Greece has a lot of reasons not to quit, and Europe has a lot of reasons not to kick them out. Well, put those two things together, and they're not going to quit, and they're not going to get kicked out. Now, beyond that, are these negotiations going to be messy? Yes. Is it going to be volatile? Yes. There'll be a lot of accusations. There'll be good days and bad days. I saw the Greek defense minister the other day, not the finance minister, but the defense minister say that they might really, I guess they've got some detention camps in Greece where illegal immigrants show up and they keep them in detention. He said, and of course under the Secession Treaty, if you're in the European Union, you can go to any other country in the European Union without customs or immigration. So you can just drive from Athens to Paris across 7 or 8 countries without any immigration formalities. So this defense minister said, we're going to open up the detention camps and release all these people. By the way, we think there's probably some ISIS terrorists in there. So the threat, in effect, was that we're going to release ISIS terrorists and they'll be on their way to Paris by tomorrow morning. Well, thank goodness he's the defense minister, not the finance minister. And this is sort of like putting Don Rumsfeld in charge of the TARP. I'm not sure how that would have ended up. But the point being, it's messy. There'll be volatility. I'm not saying this is easy. A lot of posturing, but at the end of the day, Greece is going to stay in, and the euro is going to stay together. So again, get ready for more fireworks, but don't read too much into it.
Staying in Europe, Jim, something happened in Austria that echoes another story we've been tracking, the so-called bail-in. There's a major bank, Hypo Alpe Adria, that was nationalized in Austria when it ran into trouble some years ago. Well, it's in trouble again, but this time the response is different. The Austrian regulators are going after the bank's bondholders rather than providing the classic government bailout. What's the significance of this?
Yeah, I think it is significant as a matter of policy. Now, just to be clear, John, there's nothing new here as a matter of law. A bondholder has always been an unsecured creditor of a bank. Unless you have a secured bond, that's different. If you got a mortgage on the bank headquarters, maybe you can foreclose on the headquarters. So there are ways to get a secured obligation, but most bonds issued by banks are not secured obligations. Deposits have never been secured obligations. They might be insured by a deposit insurance scheme, but they're not secured with a security interest. So depositors and bondholders have always been unsecured creditors of the bank forever, again, but for deposit insurance or in a small number of secured bonds. So that's not anything new. However, it is true that for about 80 years, since the Great Depression, depositors have kind of taken it for granted that if you're a depositor, you have some kind of sacred obligation from the bank to give you your money back, and you're not at risk. That's never been legally true, but it was taken to be true. Same thing with bondholders, because of the famous, the Greenspan put, which turned into the Bernanke put, which turned into the now the Yellen put, and the whole doctrine of too big to fail. People who were lending unsecured to banks said, okay, maybe I'm an unsecured bank holder, but banks are too big to fail, and if this bank gets in trouble, the taxpayers are going to bail it out. I'll get my money back. And that actually was true in as recently as 2008. No bondholder took a nickel of losses. I'm incredulous to that. I know it's a fact, but to this day, I can't believe that nobody had to take a haircut. The only bondholders who took haircuts in that whole 2008 fiasco, to my knowledge, were some hedge funds who owned Chrysler bonds. Not the unions, by the way, just the hedge funds. And, of course, Chrysler is not a bank. But Fannie, Freddie, Citibank, JP Morgan, Goldman, Morgan Stanley, Bank of America, you name it, no bondholder took a nickel of losses, even though taxpayers bailed out the banks to the tune of trillions of dollars in terms of guarantees and et cetera. Now, what's happened since then is that I'll say the regulators, but really people more powerful than the regulators. This is more the G20, finance ministers, people at the IMF, people at the board of governors of the Fed more so than, say, the New York Fed, who kind of are in bed with the banks, they came to the realization that we can't afford this anymore. Maybe we did it in 2008 because we weren't ready for it, and the alternative was worse. And I disagree with that, but I'm just sort of trying to describe how they viewed it, and the alternative is worse. But they said, we can't keep running this again because one of these days it's going to be bigger than the central banks. And of course, that's something that listeners and others have heard me say before, that the next crisis will be bigger than the central banks. But there's an extent to which the central banks have started to realize that themselves. And certainly politically, the taxpayers have no appetite for this. The taxpayers did bail out the entire system in 2008. But that was politically unpopular. Remember, the TARP, which was the big U.S. bailout program, when that was put in the House of Representatives on the first vote, it failed. That TARP bill did not pass the House of Representatives. Then the stock market fell 800 points that day from a much lower level, by the way. So that would be well over, on equivalent terms, well over a 1,000 point drop today. And then that kind of spooked the Congress, and then Bernanke said, look, if you guys don't do this, the whole system's going down. So now how do you feel? And so Congress passed the TARP on a second vote. But that was close. And so it shows how unpopular this is with the taxpayers. So the combination of, are we feeding a crisis bigger than ourselves, bigger than our own central bank capacity to squash it? B, are we politically jeopardizing the ruling parties by doing something so unpopular that they're going to throw us out? And if the answer to both those questions is yes, then you have to try to prevent it. So what they've done, I say they, again, it's not some deep, dark conspiracy. These are, G20 finance ministers and people from the IMF and people who have names. I mean, the real people, and they put up public documents. What they've done is said, okay, from now on, if banks fail, bondholders will suffer losses. And you depositors, if you have more than the insured amount, you're going to suffer losses. I think the insured amount, check me on this, I think it's $250,000 to them in the U.S. I'm pretty sure that's correct. But, $250,000 is a lot of money for the average saver, certainly the average citizen. That's a huge amount of money. But it's not for corporations, and it's not even for small businesses. I mean, if you're you don't have to be Exxon, you could be a dry cleaner or a successful pizza parlor operator or running a small manufacturing company or having a small distribution company. You could easily have working capital balances in excess of $250,000. And what the regulators are doing is they're saying, advertising in effect, you are not safe. You are an unsecured creditor. If your bank goes down, your money is at risk. Now, there are two examples of this. One, I think the best known one was Cyprus, which is on the euro, by the way. They're a member of the Eurozone. And we saw bank depositors in Cyprus a few years ago suffer losses, and bondholders suffer much larger losses, and stockholders got wiped out when they had to bail out the Cyprus banks. But the other one is the case you mentioned, the Hypo Alpe Adria Bank in Austria, where the same thing happened. So you're on notice. I mean, they're telling you. So don't be shocked or outraged or say, oh my goodness, how could this happen? First of all, it's always been the law. It wasn't always the policy, but it was always the law. Secondly, they're telling you loud and clear. And I would refer interested parties, go back to the Brisbane. Last November, there was a G20 summit in Brisbane, Australia. One of the things I say about the monetary elites is that they do tell you what they're doing. Now, it's real geeky, and they use a lot of jargon, and you got to dig hard to find this stuff. I call it transparently non-transparent, meaning they tell you what they're doing, but good luck finding it or good luck understanding it if you do find it. But if you want to go back to the G20 Brisbane summit last November and go to the communique and look at the appendices to the communique and go into the working papers, you will find blueprints for the bail-in. And they actually use the word bail-in. So there's no mystery about it. So as I say, get ready to lose money when the banks go down, which, by the way, is a good reason to own gold. Gold in physical form outside the banking system is immune to this. So I would not have all my money in the banks. You need some money in the banks for working capital, but I would have some in physical gold outside the banking system because you're not going to get bailed in.
And clearly, by implication, what happened in Cyprus, what happened in Austria could also happen here where we are in the United States.
That's exactly right. Look, the U.S. is a member of the G20. We signed on to the Brisbane Communique. As I say, it's always been the law. I don't claim to be an expert in the banking laws of 185 members of the IMF, but I am a U.S. lawyer, and I work for banks, bank holding companies, investment banks. Had a long career as a regulatory counsel to banks, basically. And so, as I say, any deposit in excess of the insured amount is an unsecured loan to a bank. It's not an entitlement. Any bond not secured by specific assets and with the right legal pledges is at risk. So get ready to lose money if the banks go down again, which is probably just a matter of time.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.